Shane, so looking ahead, how do you and the team see the next quarter in terms of the markets, the funds, our portfolios, and how do you think the rest of the year is going to pan out?
Difficult question. Future is always hard to predict. However, based on some of the models that we look at through different institutions, there is a good argument that 2019 should end up being a positive year. There's echoes with 1984 and 1994 with 2018, and the subsequent years, so 85 and 95, were extremely buoyant years. Right? There's nothing to say that 2019 can't be a positive year as well. Yes, there are issues in the world. We still haven't quite got the trade agreement set out, and Trump has then started looking at Europe for more trade tariffs, cheese, wine, German autos. So he might be switching his attention to Europe rather than China, and we still have Brexit to get over the hurdle. However, that's saying we do have to anticipate that the economic cycle is starting to slow. Not necessarily collapse, but starting to slow. But we still see 2019 being a positive year. Now we look at lots of different recession type models, and that indicates a 25% chance of a recession this year. What does that mean? It means probably the likelihood of a recession being sometime in 2020. That's sort of our base case. No need to panic yet, and the models still take into account the underlying funds and the stance they're taking as well. So I'd say 2019 should be a positive year. We're looking more towards 2020, where recession risk would increase as the cycle starts to slow more dramatically. But if central banks intervene again, that could be elongated as well. Don't forget, this recovery has been one of the longest, but almost the most gradual as well. So we anticipate it to be a little more elongated than the rest. And as we get towards the end, you're going to get more volatility as well. So you see I've swerved what this quarter is going to be like. April's off to a good start already. Some of the forecasts and some of the updates from the companies in the US in particular have been fairly favourable this year. But within that data, you're seeing unemployment at an all-time low, and the US hit an all-time record high yesterday. They tend to be indicators of the peaks of the market, so you would expect it to start to slow down thereafter. But we shouldn't be afraid of a bear market and recession. We think it's going to be a typical one rather than the 50% drops we've seen in the past. So a cautious outlook, but ready to take on board as much return as we possibly can.
Thanks, Shane.
You're welcome, Brian.